If you clicked on this video, there's a good chance you're committing some serious tax blunders that could result in you getting that dreaded audit letter from the IRS in the mail. And honestly, it's not your fault. There's a ton of misinformation spread online around business taxes that even your financial planner or accountant could be participating in. So in this video, I'll be listing the 8 most common mistakes business owners make that turn them into walking red flags for the IRS. The first is the home office deduction. So you're allowed to deduct a home office if it's exclusively used for business. And this is where people mess it up. So if you have an area that is used for not only business, but maybe you also eat there or you also sleep there, that does not qualify as a home office. The room that you're using as home office, it has to be used exclusively for business. So a red flag for this can be taking a very aggressive home office deduction. So when you're filling out that form, you actually have to say what the square footage of your house is. So if you say you have a 2,500 square foot house, but 1,700 square feet of it is for your office, that's most likely going to be a red flag. Okay, number 2 is distributions versus payroll. So this comes into play with S Corp. So people elect to become an S Corp to mitigate self-employment taxes usually. But what most people forget is when you're an S Corp, you're required to pay yourself a W-2 salary, a reasonable salary. So if you go all year without paying yourself a salary and go to file your tax return and they see that you're an S Corp, but there's no payroll to you, the shareholder of the S Corp, that's a huge red flag. They'll probably reclassify some of your distributions as salary, and they could even revoke your S Corp status. The next is suspicious tax deductions. So some tax deductions are just super suspicious. Like there's people that try to write off their boats. That's probably not going to fly, right? Travel is another big one. And there is a lot of legit business travel, but you just want to make sure that you are heavily documenting the business purpose, the receipts, the itinerary for when you're traveling, that sort of stuff. And the other one is large charitable contributions, which is super common here in Utah. So if you're contributing a ton of money to a charitable cause, there's a pretty decent chance that that's going to raise some red flags. The next is in regards to vehicles. So you definitely can write off your vehicle. You can use section 179, you can do the bonus depreciation, or you can just take mileage or the actual expenses. But where people go wrong here is they go to deduct a vehicle and they only have one vehicle, but then they claim that it's 100% business use. That's a huge red flag because the IRS is going to go, okay, how do you take your kids to school? How do you get groceries? That sort of stuff. And if you only have one car and it's 100% for business, that just doesn't really compute. Another note too with that is the bonus depreciation is not 100% anymore. It was actually 80% in 2023. In 2024, it's 60%. 2025, it'll be 40%, all the way down to 0. The next would be a high percentage of meals as business expenses. There is business meals that you can write off. If you have a total business expense of $100,000 for the year and like $60,000, $70,000, $80,000 of that is meals or something just outrageous, just a high percentage, that's definitely a red flag. But you can write off some business meals. Say you flew to a different state for a business conference or to meet with a client, the meals for that trip would be tax deductible. Or if you catered a meal for your team members, that would be deductible. But driving on your way to the office and stopping at Starbucks or McDonald's, that is not deductible. Any meal with yourself alone, unless you're traveling outside of the city of your business, is not deductible. Another red flag is having round numbers on your tax returns. So if on your tax return, all of the expenses, all the numbers end in 0.000 cents on every single one of them, this is a super common IRS trigger. It just looks fake. It makes it look like you're guessing and not using the exact calculation. And the next one would be under reporting. So for a business owner, this is typically would be like omitting 1099s. So say you received some income from whatever source. Maybe that money actually came into your personal account. Maybe you received $10,000 into your personal account. You go, okay, I'm just not going to report it. Well, if you get filed that 1099 and you have your income statement and you file your taxes and your income is that $10,000 less because you didn't put in the 1099 info, they're going to look at their records and be like, hey, we have this guy making this $10,000 over here that he didn't report, and that can trigger an audit. And lastly would be crazy lifestyle items, but showing little income. So, if you have a huge house, you're posting on Instagram all your huge houses and your Ferraris and Lambos and all that stuff, but on your tax return, you make 10K a year or 20K a year or not very much. This definitely puts you on their radar. They're going to think, okay, is he doing illegal stuff? Are they a scammer? What's going on here? So that's definitely a red flag, the discrepancy between lifestyle and what you're showing on your tax return. So those are the top 8 mistakes businesses make that can trigger an audit. Hopefully after watching this, you can correct those mistakes in your company before tax season rolls around. And if you are a business owner that knows that you need help in their accounting, but you just don't have the time or the know-how to do so, there's a link in this description breaking down how we might be able to help you. Thanks for watching. I'll see you on the next video.